Accounting and the Business Environment, Chapter 1. Financial accounting focuses primarily on reporting financial information related to the financial position of the company, the results of its operations, and its cash flows to external stakeholders. The processes used to develop this information are prescribed and governed by a set of accounting rules, standards, or principles. Managerial accounting focuses on the processes that generate information that can be used by internal management to make better decisions about the day-to-day operations of the company. Accordingly, this information is not as prescribed. While the concepts may be constant across companies, the specific kinds of information and reports often differ depending on the company and the situation. External decision makers, or stakeholders, include people like stockholders, creditors, suppliers, customers, employees, and regulatory agencies and bodies. Each of these groups have a need to know how the company is doing, how financially healthy it is. Internal decision makers are primarily employees and management. Their goal relates more toward using information to help them be more successful in their work efforts. When we get to a triad like this one, you'll see, for this one specifically, you'll see several choices and then, or several vocabulary type words or phrases, and then A through F here, allowing you to choose which one matches with which. But for all of the triads in the book and the slideshows that we'll look at throughout this course, the way that I want you to do it is take a look at the questions and answers here, and then I will pause in between each question and the right answer so that you have time if you want to just pause it and see if you can figure out what the answer is on your own. So that would be for certified management accountants. You can see answer choice is E. So then you want to keep going through, and I'll just pause a few seconds in between each question and the answer just so you have time to take a look at it, pause, and then start back up. The SEC was established by the Securities Act of 1934 during the administration of President Franklin D. Roosevelt. Prior to 1934, there was essentially no organized government structure for overseeing the financial reporting of companies that were publicly traded. Among other things, the SEC requires that all publicly traded companies have an annual financial statement audit that is conducted by a CPA. In addition, the SEC is charged with establishing the accounting standards and principles by which financial accounting information is developed. The SEC delegated that standard-setting responsibility to the accounting profession. Through a series of different bodies and over many years, the body of accounting standards, thought of as generally accepted accounting principles, was developed. Currently, the body that is responsible for setting accounting standards in the United States is called the Financial Accounting Standards Board, also known as FASB. Located in Connecticut, it is a body of 7 highly qualified individuals supported by several hundred staff members that spend its time considering the most appropriate way to properly account for and subsequently report on the results of business transactions. In addition to the FASB, there is also an international body called the International Accounting Standards Board, located in London, that has established a body of international financial reporting standards, also known as IFRS. These are used by a majority of other countries. Currently, the United States is working on converging U.S. GAAP, or generally accepted accounting principles, to be more equivalent to their IFRS counterparts. Generally accepted accounting principles are referred to as GAAP. The entire body of GAAP is constantly evolving and changing. In the past, GAAP was published annually by the FASB in a multi-volume set of books. However, recently the FASB has made the body of GAAP available online as part of its accounting standards codification project. One of the guiding philosophies of GAAP is that the information generated by the financial accounting process should be useful. Usefulness can be defined for accounting purposes as a function of two related concepts, relevance and faithfulness of representation. In addition to the concept of usefulness, there are other guiding principles underlying all GAAP standards. One of these is known as the economic entity assumption. This states that a business stands apart as a separate economic unit that is separate from its owners and that keeps its affairs distinct from those of other businesses. We also have something called the cost principle. This states that all assets and liabilities should be recorded at their actual cost on the date that they were acquired, the date of acquisition. Assets and liabilities will continue to be reported at their historical cost over their useful life. In other words, except in certain cases, we will not adjust the carrying and reported amounts of assets and liabilities to their relative market values. We also have something called the going concern assumption. This states that we assume that a company that is currently in business will remain in operation for the foreseeable future. This assumption is essential if we expect businesses to engage in long-term agreements. For example, it might not make sense for a business to acquire an asset that will last for a number of years, if the expectation is that the business will soon discontinue operations. Also, a manufacturer would not likely enter into a long-term sales agreement with a customer if it believed that that customer would soon be out of business. Lastly, we have something called the monetary unit assumption. In the United States, transactions are recorded in US dollars. We continue to use dollars as the unit of measurement even when the underlying value of the currency changes. For example, if there is inflation. This also puts a limitation on what we can record on the balance sheet. We can only record assets and obligations on the balance sheet if we can measure them in dollars. For example, a company may have spent many years developing a valuable name recognition in the community. However, since there is no cost that can be measured for this good name, the asset does not show up on the balance sheet, even though we all know good and well that it is in there. So here we have another try it. So once again, it's a matching try it, and I will just pause briefly in between each number so that you have time, if you want, to pause the computer and see if you can answer correctly. The accounting equation is the essential foundation of modern accounting. Stated as a mathematical equality, it establishes that an equilibrium must exist at all times. This equilibrium is stated as assets equals liabilities plus equity, or owner's equity. We will define each of the elements of the accounting equation. For now, understand that this equation must always stay in balance. If something happens to change one part of the equation, there must be an equal but opposite change somewhere else in the equation to keep it in balance. Assets are defined as economic resources that are expected to benefit the business in the future. Generally, these economic resources are owned or controlled by the business. They can be tangible, such as cash, land, inventory, buildings, or equipment. Alternatively, assets can be representative of claims that the company has against other entities. These can include accounts receivable, notes receivable, or investments in other companies. Finally, there are actual rights to assets that lack physical substance, but that are owned by the company. These might include things like patents, copyrights, trademarks, and databases. Liabilities include all of the debts and obligations that the company owes to others. They can also be thought of as creditors' claims against the assets of the company. Liabilities can include obvious debts like loans payable, utilities payable, accounts payable, taxes payable, and salaries payable. In addition, there are obligations that are created in the process of doing business, such as unearned revenues. This is the obligation that is created when we accept cash from a customer before we've performed a service or delivered a product. Warranty liability is the estimate of the amount of warranty work that we will have to perform on products we have sold. And then we have contingent liabilities. An example of this would be an amount we are likely to owe to others as a result of a lawsuit. Equity or owner's equity represents the concept of the owner's residual claim against the assets of the company. So, all assets can be claimed by either the creditors of the company or by the owner of the company. As the company earns resources, the assets increase and the owner's claim against the assets of the company will also increase. Likewise, as the company incurs expenses, the owner's claim against the assets of the company will decrease. The other thing that can change the owner's claim against the assets of the company is the amount of resources that the owner puts into the company or the amount of resources that the owner takes out of the company. When an owner takes resources out of the company, these are called owner's withdrawals. The amount of the annual withdrawals is usually limited by the business to prevent an owner from taking out more resources in a given period of time than the company can sustain. A company's revenues represent the monetary value of the goods sold to or services performed for customers. Revenues are always recorded at the time they are earned, even if the related cash has not yet been collected. In financial accounting, it is important to begin thinking of the earnings process as being separate from the collection process. Expenses represent the dollar value or cost of the resources we have consumed or used in the process of generating revenues. When matched against revenues, we have the concept of income. When revenues are greater than expenses, we call the difference between revenues and expenses net income. When revenues are less than expenses, we call the difference net loss. So here's another try it. All transactions are essentially very special forms of historical events that involve the exchange of economic resources for the purpose of commerce. Not all commerce events are transactions, only those that we can measure in US dollars. For example, if we buy a copying machine for $4,000 cash, this is a transaction. Economic resources exchanged hands and the transaction can be measured in US dollars. However, meeting with a customer, while arguably an extremely essential business practice, is not a transaction because no economic resources were exchanged. When we merge the concept of the accounting equation, the fact that both sides of the equation must always stay in balance, with the structure of a transaction, we can begin to analyze how transactions impact the financial accounting system. In the first example, Sheena Bright has started a new business called Smart Touch. She puts $30,000 of her own cash into the business. From the perspective of the company, Smart Touch has increased its cash by $30,000. However, if we stop here, then the left side of the equation will have $30,000 and the right side of the equation will have $0. Clearly, this would make the equation unbalanced, and we know that the equation must always be balanced. So we recognize that when cash went up by $30,000, the owner's claim against the business also went up by $30,000 as a result of this transaction. In transaction number 2, Smart Touch purchases land for $20,000 cash. In this case, cash is decreased by $20,000. At the same time, land, which is a different kind of asset, is increased by $20,000. Essentially, we effectively turned one kind of economic resource or asset, cash, into a different kind of economic resource or asset, land. All of the changes necessary to keep the accounting equation in balance occurred on the left side of the equality. In transaction number 3, Smart Touch buys office supplies of $500. Rather than pay for the supplies at the time of purchase, the supplier has offered to let Smart Touch pay later, usually in 30 days. Although it may seem highly unusual for you and I to purchase goods in this manner, it is not unusual for businesses. When an individual consumer purchases goods, they are usually paid for on the spot with either cash, a check, or a credit card. In the later case, the credit relationship is between you and the card company, not with the store. Business transactions are most often done on account. This means that the purchaser will take possession of the goods now, but will not have to pay for them until later. In transaction number 4, Smart Touch provides training services to customers. The customers pay cash for the services. You should think of the earnings process and the collection process as two separate processes. In this case, they both happened at the same time. Often, however, a company will earn revenues by providing a service or delivering a product, but will not collect the cash until a later date. In transaction number 5, we have an example of what was discussed in transaction number 4. Smart Touch performed $3,000 of services for a customer, but did not collect the cash. The customer is not expected to pay until the end of the month. In transaction number 6, Smart Touch pays $3,200 for two expenses, $2,000 for office rent and $1,200 for employee salaries. In transaction number 7, Smart Touch pays for part of the office supplies that are purchased on account in transaction number 3. This decreases Smart Touch's cash while reducing the amount that Smart Touch still owes to the supplier. In transaction number 8, Smart Touch collects $2,000 from the client to whom services were provided in transaction number 5. Note that while cash goes up, the amount owed to Smart Touch from the customer declines by an equal amount. When we put all of the transactions together, we can see the balance in each account. In addition, we can see the left side of the equation balances with the right side of the equation. There are 4 primary financial statements used by all companies: the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Together, these statements tell us about the financial health of the company. The statements are also linked to one another. The income statement is produced first. The net income number then flows forward to the statement of owner's equity. The net income number is combined with the beginning balance in owner's capital and any contributions or withdrawals made by the owner during the period to arrive at an end-of-period balance for owner's capital. The ending balance in owner's capital flows forward to the balance sheet and serves as an important balancing element. The statement of cash flows is based on information from the other statements and then is reconciled back to the cash balance on the balance sheet. The income statement tells us the results of operations for a company for a given period of time. The statement is always produced first. Here we see the income statement for Smart Touch Learning. After the heading, which identifies the name of the company, which statement is being presented, and the period covered by the statement, we list the revenues for the period first, followed by the expenses for the period. Generally, the largest expenses are listed first. Net income is shown at the bottom of the statement as the difference between revenues and expenses. In the event that expenses exceed revenues, we would show a net loss instead of net income. The statement of owner's equity shows how the owner's claim against the assets of the company have changed during the year as a result of the company's operations and ongoing contribution and withdrawal activities. As an owner contributes additional money and assets to the company, the owner's claim against the company's assets increases. On occasion, an owner will pull cash out of the business, called an owner withdrawal. This will reduce the owner's claim against the assets of the company. As the company has net income, the owner's capital in the business also increases. The balance sheet, which is sometimes called the statement of financial position, reports the company's assets at a given point in time. Each account is measured as of the date of the statement. The owner's capital balance comes from the statement of owner's equity. Essentially, a balance sheet has two major sections, one for assets and a second section for liabilities and owner's equity accounts. These two sections must balance just like the accounting equation requires. Finally, the company prepares the statement of cash flows. This statement helps to explain where the company's cash came from, where it went, and whether, as a net result, the company is able to pay its obligations. The statement has three main sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The net total of these three categories of cash flows should equal the net change in cash from the beginning of the period to the end of the period. The statement is completed by preparing a short reconciliation. By adding the net change in cash for the period to the beginning cash balance, the result should be equal to the ending cash balance. For Smart Touch Learning, the majority of cash for the period comes from financing activities. However, it is a positive sign that Smart Touch collected more cash than they spent in the operating activities section.